You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, that music means it is time once again for OPR, what the cool kids call Options Playbook Radio. Of course, the program where we break down all of the fascinating, sometimes confusing, sometimes head-scratching plays that you can use in your own portfolio. You want to go on offense, a little bit of speculation, maybe a little bit of income. Maybe you want to play defense. Wouldn't blame you right now if you wanted to play a little bit of defense. Either way, we've got you covered. My name is Mark Longo from TheOptionsInsider.com, as well as, of course, from this fine network upon which you're listening to this program, and just about everything else right now. Hopefully, if you're listening to OPR, you've done the extra legwork and gone and subscribed to the full network, because a lot of good stuff there to keep you engaged, keep you informed, enlightened, and maybe a little bit entertained as well in these somewhat harrowing times that we're all living through together. And, of course, keep those questions, those comments coming. And if you like what you hear, and a lot of you plainly do, keep those reviews coming on your platform of choice so new people can continue to discover this fine program. It's more necessary than ever in these markets right now. If you're saying to yourself, wait a minute, that guy's not usually on this show, you are correct. So allow me to introduce your usual host and the author of the titular Options Playbook, Mr. Brian Overby, the senior options analyst, a.k.a. the Options Guy over there at Ally Invest. Brian, welcome back to your own show, sir.
Oh, wow. Thank you so much for that wonderful introduction, Mark. And I always love it when we get a chance to host a show together, because that means we're going to answer some listener questions. And man, have they been coming in. So I think we're going to take the time to huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
Love that transition. Someone gets crushed there at the end. I'm not sure who that is, but I feel bad for that guy. But I don't feel for you guys, because you guys have been just deluging us with your questions of late. We love all those questions. Keep them coming. You can hit us up at all the usual places, the website, all the social media accounts. Just search for @options. Go to optionsplaybook.com. You can send them over there or directly to Brian over there as well. Let's kick things off. Actually, the question we asked you guys, we've been getting your pulse on a lot of different issues of late, because a lot of things are going on. These are fairly unprecedented markets that we're all experiencing together right now. We asked you about a week ago or so here on the network. VIX at the time had just broken through 30 to the downside. Spoiler alert, it's still right around there, right around 28 or so, 28 and change as of right now. So we asked you, is this the end of this recent resurgence we've seen of volatility? Of course, VIX got all the way up to 80 plus and then came right back down. Obviously, a VIX of 30, still elevated, so by no means are we saying there's low vol, but it's much different, perhaps, regime than it was even a month or two ago. Or you think this is just setting the stage, a little bit of an inhale, a little bit of a break before volatility skyrockets back north again, and traditionally that usually means the market heading back south again. So quite simply, we asked you guys, where do you think VIX and or spikes will be about a month from now? We gave you 4 choices. Higher, so north of 35. Lower, south of 25. Right around that level that it was at the time, which was about 25 to 35, nice 10-point range. Or you don't care because you're in cash. And as of the time of this show, right before this poll ended, right about 46% saying you think VIX and spikes will be higher, aka north of 35. So that traditionally means that the market's going to be a little bit lower. Speaking of lower, only about 19% of you chose lower, below 25. And right around here in this 25 to 35 range, right about 27%. And you don't care because you're in cash, right about 8.5%. Brian, this has kind of been a frequent talking point on our network. I just got off our advisor show earlier today, and a lot of people are analyzing and crunching the data as well, because right now, as we're recording, the market's finished up yet again. S&P up 1.5%. NASDAQ within spitting distance of its all-time highs again. We have effectively seen now this second leg of this quote-unquote V-shaped recovery that everyone was talking about. It has effectively materialized in the market, which leaves a lot of people scratching their heads, including, it seems like, our audience, as to what the heck is going on. So I'd be curious to get your thoughts on the current levels we're seeing out in the marketplace. Are you and or ally clients really buying into this rally? Also, what are your thoughts on what we're seeing out there from a vol space? Obviously, VIX staying somewhat elevated means perhaps another shoe to drop. What's your take on all this madness we're seeing unfolding right now, sir?
Well, one of the big things that I do see that happened in the S&P 500 index this week, we actually had a pretty good gap opening on Monday, and we are actually above all the moving averages in general, the ones that a lot of people like to focus on. We're above the 50-day, 20-day, the 200-day moving average, which is usually a really good trend set. Like if you're looking at the market and you could say, well, you got to kind of say we're a little bit in an uptrend when you get all the S&P 500 index above all of those moving average. That's usually a good indicator to the upside as far as the stock, as far as where the trend is at. But then you turn around and you take a peek and you look at the VIX and you say, well, why is the VIX flat today? Basically, the VIX was down 39 cents or 1.3%, and you look at the S&P 500 index, and you see that was up 1.4%. So the VIX is down less than what the S&P 500 index is up, and that's very rare that you're going to see that scenario. And another thing that's kind of setting the trend here, saying a little bit more to the upside, is we're actually seeing the Russell 2000 index start to come back, and that Russell has been leading the way to the upside. Now, it led the way to the downside, but today I'm seeing that the Russell is up about 3% as opposed to the NASDAQ that was up 0.77%, and the Dow that was up 2.21%. So we got the Russell leading the way. We got the S&P 500 index over all of the quote-unquote popular moving averages, but the VIX just will not come down. And you really need that in order to kind of even just break a trend to the downside. But so very odd times, without a doubt. All the volatilities on all the stocks that we've talked about on Options Playbook Radio have came off quite a bit. Even going into earnings, we're seeing the implied volatilities actually decrease as we approached earnings, which that was another weird thing. But then again, they were at all-time highs. So, I mean, that it just is. It's unprecedented times, but it's also makes for interesting trading too. I'd much rather trade with the VIX around 30 than the VIX being around 50, but I'd also rather trade with the VIX around 30 than the VIX being at 10, right? I think having some volatility for option traders, people that are actually swing trading, doing some positions for over the short term, I think overall we kind of like some volatility, as most option traders are. So if you're not trading, if you are considered yourself an option trader, you should be trading now. That's simply.
Yeah, that's very well said, and you're right. I've often said, what is that level of VIX, which is the take your ball and go home level? It's just too much for most people. And traditionally, it's been around a 35 or so. So we were north of that for protracted period, many months, and yet we still saw a lot of volume coming in. So some folks got somewhat adapted to the new vol environment, and then clearly we have some new vol coming in ahead of us, whether it's staying at these levels, whether it's coming in. If you guys haven't voted, we'll have more polls for you over there. But I want to get to some of your OPR questions here as well. A lot of questions flying fast and furious here. First off, This comes from Cote, maybe Cote. I'm going to go with Cote. Sounds fancier. Cote wants to know. Says, this is for Brian Overby of the Options Playbook radio program. Well, you sent it to the right show, Cote. You passed the first test. He says, hello, Brian. I'm very much enjoying your weekly show. Thank you for all of the knowledge that you share every week. I'm a fairly new options trader. And he puts in parentheses here, and an ally customer. Well, there you go. I would like to know if the change in commission structure has caused a bit of a change in the types of trades that Ally's clients are doing. Or are they pretty much doing the same types of options trades as before? Thanks again for your show. I tune in every week. Well, interesting stuff. I like to see the Ally faithful dialing into the show here as well. We love to hear from everybody out there. But Brian is obviously referring to a few months back towards the end of last year when we saw most of the major brokers effectively waiving their ticket charges. And so a lot of the trades that were very expensive got a wee bit less expensive. And I guess Cote and a lot of our listeners out there are curious if you've seen any maybe changes in trading patterns as a result, Brian?
Not necessarily in the types of trades that are being entered, like the initial strategy. But one of the things, and this is some of the feedback that I've received from our clients overall, is that you don't have to think about how you're getting in and out of your trades when there's no ticket charge. For example, let's say we had a 10-lot iron condor on, right? And I want to take off a couple of the spreads because they went the right direction. So now I just go and do it. There's no ticket charge. You don't have to think about legging it out as a spread. I just want to buy a short option back. I buy it back. And commissions are, obviously coming down overall. But I think the big thing for the option trader here is to get rid of that ticket charge so that it costs you just as much to get out of a spread as it does a single leg option. Right? So there's no benefit to trading in spreads anymore. And that's a good thing. It makes it easier to adjust your positions, trade the position, add to it, take away. And so, yeah, overall, the feedback's been great from our clients, especially our option traders.
Yeah, a little bit lower cost is a good thing for everybody out there. All right, let's keep on cranking. Brian, getting a lot of direct questions coming your way here. Next up comes from Teller. Maybe he's a bank teller. That job's kind of going the way of the dodo, especially these days. But an interesting question here. He asks, does Brian ever trade traditional butterflies? Seems like he only trades skip strike flies. Well, Brian, you are known, somewhat infamous for your love of the old skip strike fly, but I seem to recall you putting up a few quote-unquote traditional flies on OPR over the years as well. So we have to say for Teller here, and maybe what are the origins of your love of the skip strike fly as well? That might be an interesting origin story to explore as well.
Yeah, I this made me chuckle a little bit, but I think I would do more butterflies overall. But I have a tendency with the butterflies. I like to roll into a butterfly. So one of my strategies, and I think I've worked through this on Options Playbook Radio. We've done so many episodes now. I'm sure I've talked a little bit about it, but is where you start out with a long call spread or a long put spread, and if the market goes against you, just rolling it into a traditional butterfly. So in other words, you got the long side of the butterfly, you go out and you sell the short side of it, and you create a butterfly. And the way that I look at that is, I don't want the cheese anymore, just let me out of the trap. That's what my goal is, because I'm obviously putting the butterfly on if it's gone against me for a higher cost than if I initially did it. But the one thing I love about doing a butterfly that way is that you're giving yourself a chance. So in other words, I'm not just closing out the position because the market went against me. I'm doing something, I'm adjusting it, I'm removing some of the risk on it, and I still got a chance that if the market comes back, that I can actually get my cash out of it or even maybe be profitable. So when we do a lot of the skip strikes, and here's the origin that's behind it, with Options Playbook Radio, a lot of times we're looking at earnings plays. Why? Because it's simple. We're looking at strategies around earnings. And when I'm doing something around earnings, I want the benefit to be, with a skip strike, you're saying if the market stays where it's at, or the market goes down, or the market goes up a little bit, and I'm just talking specifically about a call skip strike, there's three different scenarios there that work with that strategy. And the one scenario that really hurts you is if the market skyrockets in the direction that you're doing the skip strike butterfly. So I think it really comes in, and I probably should talk a little bit more about traditional butterflies, but I think it comes from the fact that we like to talk about strategies around earnings events and big events. And that's where the skip strike really is interesting to me overall.
Well, your questions are interesting to us. Let's see how many more of you we could squeeze here on the program. The special, extra special huddle, pandemic huddle edition here. You had a few of these. Now you guys seem to be enjoying them. Clearly your questions are flowing fast and furious here. Indelia wants to know, Brian, this has been a hot topic on the network of late. I'm sure this is probably why this question has come in. We've been talking a lot about time spreads, and it seemed like once you mention those, the questions start flowing fast and furious. So time spreads seem to really, just for whatever reason, trigger people out there in a good way, trigger them in a good way with good questions. And Delia wants to know, what is the right environment for a time spread? If you're not familiar with what a time spread is, listeners, I encourage you, go check out Options Playbook Radio, or go listen to some earlier episodes of this program where Brian breaks all that down in a great deal of detail. I'm assuming, in Delia, for our purposes, you mean a traditional type time spread, maybe going out about 2 months, buying, let's say, an at-the-money call, and then turning around and selling the front month or 1 month at-the-money call, and hence you have that traditional time spread. But it is, Brian, as I said before on the network here, time spreads are kind of more of an options 201, maybe even an options 301 type topic, because they're so counterintuitive. You're buying premium, yet you want the market to sit. All sorts of weird things are going on in a time spread. So what do you have to say here for Indelia, who wants to know, what do you think is the optimal environment for doing a traditional time spread, Brian?
Well, you're right, Mark. I'll say this, that the hardest topic to discuss or to try to teach is a time spread, because you can never say exactly what the back month option contract will be trading at, or what implied volatility and these other factors that affect option prices when the short month option contract expires. So if you're looking at time spreads, it's one of the hardest things to really get a grasp on. Now, with that said, is this the right environment? Here's what I'd say. I would rather be doing time spreads in a higher volatile environment where you have some premium than a low volatile environment, right? So I'd rather have the VIX at 27 than the VIX at 10. So in general, that's kind of the way that I would look at it. Now, if I'm doing a time spread, Mark actually mentioned selling a 1 month option contract and then buying a 2 month option contract. When you have this type of environment, you don't have to go out quite as far in time, and you don't necessarily need a huge event. So because there's so much volatility just in general in the option contracts overall, I have looked at it doing a few time spreads where I'm literally just selling a 2-week option contract and then buying a 4-week option contract. So if I'm doing the time spreads, I'm going to probably shorten the time frame that's around it. And then if you go back and look at Options Playbook Radio and some of the time spreads that we talked about, I also would rather have the long option contract, maybe have a known event like earnings or something that's going to happen. And that helps increase the option contract volatility that you bought, while you're looking to decrease the option volatility and time value of the one that you sold. So, yeah, I don't mind this environment whatsoever. If the volatility just gets way high, then it just gets a little bit crazy for me. I'm not going to say the VIX at 27 is way high at this point in time, but one of the things that you also need with the time spread is you need the stock to go towards a specific strike. If I'm doing time spreads, I'm probably going to lean either bearish or bullish. I'm going to pick a direction. And if I'm going to the bear side, I'm going to use puts. And if I'm going to the bull side, I'm going to use calls, because I'd rather deal with lower priced out of the money options on my time spreads just overall. But yeah, in general, I'm going to say thumbs up for the right time to be doing some time spreads.
Interesting. If you guys and Delia and everyone else have a lot of questions about time spreads and you've already devoured the back episodes of OPR over there, we just did a great episode about this exact topic on Options Bootcamp. Should be hitting the network if it hasn't already by the time you hear this, so you can check that out. Lots of your questions. Deep dive into time spreads, into great data crunching on what Brian just said, using the weeklies versus the monthlies. A lot of fun stuff there, so check that one out. All right, next up, Nicholas. This is kind of related to what you were talking about recently on the show here, Brian. He wants to know, does Brian prefer to take off multi-leg trades like Straddles and Condors as a unit, or by legging out of the individual components based on performance? Thanks. This is a frequent point of contention out there, Brian, how you take these types of trades off. Because obviously, a straddle is one of the ones he mentioned that's kind of the most infamous example of this type of thing. You buy in a straddle, typically both legs don't work out in your favor, at least for a lot of the retail who are looking at direction. If you're a pro and you're gamma scalping, it's a bit of a different story. But if you're a retail, you're buying a straddle, you probably want some movement. And so it's probably going to trend in one direction. So then people end up taking off usually the leg that works and maybe keeping the other one on as a freebie or low-cost one. Hopefully you made all your money back and more. But it raises the question of these types of trades. Do you prefer, Brian, as, Nicholas wants to know, do you prefer in these types of environments to maybe leg out of a straddle, or he puts a condor? I'm going to throw a skip strike fly in there, too, because I know that's your favorite. Do you prefer legging out of those piecemeal or taking them on and off as a unit, Brian?
Well, overall, like the long straddles, and I think you summed it up well. So we talked about a long straddle in last week's program on the airlines, kind of an interesting long straddle that we looked at. But yeah, overall on a long straddle, if I'm put in that position on, I have a tendency to leg out of them. Just because you have so much risk because you're paying so much time premium that if you get one side of that long straddle going with you, I will have a tendency to close it and then let the other side ride. Now, on Condors, I'd like to roll out of them as spreads. Now, not necessarily saying that I'm going to do all four legs and close it, but I would rather a condor. I'm going to talk about an iron condor. He just says condor here, but I'm going to say an iron condor where you're short a call spread and short a put spread. When I'm in that scenario, I have a tendency to just close out that short spread on one side, or it could be on the put side or on the call side. So I guess it depends on each individual strategy. And then Mark threw a little twist in it and said, looking at a butterfly, if I'm in a skip strike butterfly, something where I have more risk than the net credit received, or if you did it for a small net debit, but ideally on a skip strike butterfly, you're doing it for a credit. So you have some additional risk above and beyond what you put that initial trade on. I'd have a tendency to take that thing off all in one. And that's usually because if the market's coming towards my short strike in that skip strike butterfly mark, I actually just like to try to close out that whole butterfly and remove all that risk overall. So it depends, and that's really tough. I know a lot of people want a golden book of answers that we do this every single time, but it really depends on the strategy that you're looking at. But don't beat yourself up if you're legging out of something. One thing that I don't like to do is leg into the trade. I'm much more comfortable with people legging out of it once they initially put it on. But if you're doing a butterfly and you're trying to leg into it, then you're just really a long option or long and short option trader. You're not a butterfly trader. In my mind, butterflies need to be put on all as one trade when you initially enter into that position.
Nice thing, going back to the earlier question, this used to be driven quite often by commissions. It was expensive to take things off piecemeal sometimes. Now you don't have that concern anymore. So if you feel it's more advantageous, like as Brian was saying with the straddle, you have one leg, you want to take that leg off, and you're worried about ticket charges, not a thing you have to worry about anymore. So at least from that perspective, it's a little bit easier for your folks out there. All right, let's wrap it up with a couple of timely questions. One from Tim first. Tim wants to know, what do you think will happen to options trading what will happen to options when the trading floors come back? And then we have a similar question from Milton. These are both kind of timely. He wants to know, will we see more flow now that the floors are coming back? Of course, as we're recording this, listeners, here in the middle of the week, towards the end of May, NYSE back in a limited capacity over there. So the stock guys are back on that front. More relevant for our neck of the woods here, SIBO announcing yesterday plan to do a limited reopening of their open outcry floors on June 8th. So coming up in a week and change over here, we should see large institutional options products like the VIX and SPX have some floor-based presence again, which I think will be kind of interesting. Anyone who's been watching the numbers, look at April, they know they're the busiest pretty much months on record. So even without a floor, even in this all-electronic environment, the numbers have still been astronomical. Of course, that's because, like I've said many times, we are in unprecedented waters here. And so this extreme level of volatility is going to drive an extreme level of volume. But that said, there are a lot of products out there like the S, Eurodollars. We haven't heard a concrete date yet from CME. That'll be an interesting one to add to that wrinkle. A lot of folks maybe think, I shouldn't say a lot, some folks out there think that perhaps we wouldn't have seen WTI trend to the negative if there were folks in there backstopping it in the old school pit trading way. So a lot to unpack here, Brian. I'm curious, what are your thoughts here now that we're seeing the floor start to phase back? What, if any, impact do you think this will have on the options market and on overall options volume, sir?
Well, I'm kind of surprised, actually, how little of impact that it had. Now, one of the biggest things is that we didn't have a big outage. So if anything, it gives you a little bit more just comfort to know that the floors will be open up in case the computer systems go down. And that's one of the big things that they've always talked about. The Chicago Board Option Exchange they have this huge floor that they have all these costs around. And there's a lot of just totally electronic trading floors that have the advantage of the fact that, oh my gosh, our systems went down. Well, we can just send stuff to the Chicago Board Option Exchange in their open outcry pit. So it does give you a little bit of comfort. But as far as the markets are concerned, you brought up a real interesting scenario. It would have been interesting to see what would have happened in the WTI if that market would have been there. We'll never know overall. But having that options floor, the volume still has been good. The markets have been fairly tight overall, considering where the implied volatilities were at, just in general. So I don't know if you'll really notice it much as an options trader, but I do know that I feel more comfort knowing that there is a physical exchange that orders can go to when things get bad.
All right. So unfortunately, Brian, that music means we've come to the end of our little huddle here. Keep those questions coming. We could probably do 5 of these in a row and not even scratch the surface of your many queries. We get it. These are questionable times. You have a lot of questions. We get it. We understand. So we're trying to be here for you. Hope you're liking your double dose here of OPR. But Brian, if listeners are out there, they want to be on the show themselves, maybe they have a question they want to send to you directly over there at Ally, where should they go? What should they do, sir?
All right. Well, you can follow me on Twitter. My handle is Brian Overby. I've been tweeting a lot more recently. And then also you can email me at TheOptionsGuy@invest.ally.com. Thanks for listening. Mark, thanks for helping me host this show. And until the next time, I hope all the options that you bought finish in the money and all the ones you've sold finish out. Be safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.